So I wanted to get your views on companies staying private longer. I feel like we may have even talked about this a while ago, but now it's a little bit different. We have a couple companies, New Relic and Hortonworks, as sort of recent examples that were valued in the private markets over $1 billion, and they're going to go out at sort of a fraction of that. What I hear from other people is that there's more money sitting on the sidelines, even waiting to come into the private markets. So high level, what's your view on companies staying private longer, and how should entrepreneurs and early stage investors think about that?
So my personal view is companies should not be staying private longer. I think that's a mistake. It is factually happening, so I don't descriptively disagree with any of the posts and feedback on Twitter about this. However, I don't think it's a very good thing for most companies.
You think it's unhealthy?
I think it's very unhealthy. I think increased transparency is a good thing. We talk about transparency in the company all the time, about companies, and going public requires increased transparency, and that's not a bad thing. Second thing is it gives you resources to acquire companies and scale. And having a fairly priced equity is key to a transaction. So let's say I was buying your company and some VC has marked me up to $1 billion. I'm like, hey, I'm going to give you all this common stock. And you're like, I don't believe in that. But if there's a public market price on that, it's very easy for me to make that transaction with you because you know it's fairly priced. So that's a really significant strategic asset. Third is I think there's a benefit to consumers. Consumers read about an IPO that's successful and they start adopting new products. So it's like a free marketing campaign. This happened with LinkedIn. It was very successful in growing LinkedIn adoption, accelerating LinkedIn adoption. Yelp, I think, has had an incredibly successful ride post-IPO. Tesla's had an amazing ride post-IPO. I think in the hands of, if Amazon went public at roughly a $300–400 million market cap.
Wow.
So in the hands of the right CEO, I think it's a perfectly attractive thing to do, actually. And in the hands of a wrong CEO, it can be problematic, but fundamentally, that's going to show up in other ways. So this idea that people are going to be distracted with the stock price, that's perfect. That's purely fiction. Like everybody in every office is distracted all the time by some random gossip. It can be based upon, this person got promoted and I don't like this person, or the food they served yesterday was terrible, or why are they now charging me for lunch, et cetera, et cetera. And so at least when you have a stock ticker in the office, you kind of know what your employee morale is doing every day. Usually these things are much more, sort of subtle. And so you have to spend a lot of time like tracking all of this stuff as opposed to just having a fundamental feel. So I don't think there's really any disadvantages of going public in the hands of the right leader who basically ignores the short-term distractions. Just assume that there's going to be some ebbs and flows in your stock price and teach the company why that happens, because there's rational reasons, and you can use that as an edification of explaining how public markets work to your employee base as opposed to running away from it.
So now you're sort of sharing a view that I think Bill Gurley has shared also.
I totally agree
but
with
it's
Bill.
Not conventional wisdom.
I know,
right?
But if you look at Bill's success, I think people should be emulating Bill more than disagreeing.
Why has that become conventional wisdom?
I think people are afraid.
What are they afraid of?
I think some people don't like scrutiny. I think you can see this parade of horribles of all the things that can go wrong, as opposed to the positives, which sometimes are less tangible. I think there have been some companies who obviously have suffered in the public environment, but maybe they should have. I think Groupon, has lots of issues and challenges, and whether it's public or private, I think those are fundamentally good debates to have because, in fact, it's not clear that the product's good for merchants. It's not clear that it's great for consumers. And it's not clear that it's transparently managed. So those are all things that are fundamentally possibly broken. So the market may be reflecting that. I think that so in any event, I think usually it's an excuse as opposed to a rigorous debate. I've seen some of the entrepreneurs I've worked with actually change their mind. I think at Yelp, we were cautious about going public based upon a lot of pieces of feedback, but I think it's been incredibly successful in every dimension for the company. I think it's improved morale. I think it's improved retention in employees, and I think the company is doing phenomenally well, and the market's, reflecting that.
And do you think there's a time in which things will change or the cycle will go back?
I mean, I think this disconnect between public and private market cap valuations, which is acute in a couple examples that you mentioned, and there'll probably be some more, will make people cautious about raising more private money because they're now seeing the downside. So Groupon was a spectacular disaster. Like they raised money at a significantly greater valuation. Zyngo is a spectacular disaster, raised money at a significantly greater valuation than what they were trading at for through most of their history. And now you're seeing more of these examples, and the lure of just private capital, infinite private capital, without thinking through what goes wrong, actually, people were forgetting about that. And now with more crisp examples, more recent examples, that may change the calculation a lot.
And how will it change the calculation if the later stage, like the Fidelity and T. Rowe Price, I'm just using them as examples, if they kind of say, okay, we're going to pull back, will that have a downward trickle effect on valuations from late stage, mid stage, and early stage?
It'll probably. I don't think it'll affect early stage companies. So when we as a seed investor or Series A investor invest, our time horizon is probably 7 to 10 years. So trying to project what the market's going to be like in 10 years is a fool's errand. It doesn't have effect on like a Series C round. This blend between venture capital, which is really Series A and B in most cases, to growth capital, which is really Series C and D. It has more of an effect on the pricing of Series D and C rounds. A and B are fairly immune from that.